Picture this. It's March in the year 2000, and a 37-year-old marketing manager up in Seattle decides to put his absolute entire life savings into a single tech stock. Now, he hadn't just thrown a dart at a dartboard, right? He'd actually done his research. He deeply, genuinely believed in this company. And for a little while, well, he looked like an absolute genius. I mean, the stock climbed a massive 300% in less than 2 years. But then, the dot-com bubble burst. Fast forward to 2002, and his massive, life-changing investment was worth a mere $5,000. He had literally lost more than 90% of his wealth. That kind of sudden wealth destruction is just a devastating pain point. And the harsh truth is, this manager wasn't alone. Millions of investors suffered that exact same fate. But here is the incredible part about all this. The exact mistakes that wiped out all those investors, they had already been identified and completely solved decades earlier. Back in 1949, an economics professor named Benjamin Graham wrote a book called The Intelligent Investor. You can honestly think of this book as a historical cheat code for the stock market. Warren Buffett actually read it when he was just 19 years old, and to this very day, he still calls it the best investing book ever written. Instead of drowning in the chaos of sudden market crashes, Graham gives us this proven, highly rational framework to actually protect and grow your wealth. So in this explainer, we're going to walk briskly through the ultimate survival guide for the intelligent investor. We'll be looking at 6 distinct mistakes. 1. Speculating versus investing. 2. Market emotions. 3. The crowd. 4. Overpaying. 5. Ignoring diversification. And 6. Margin of safety. And it is absolutely vital for us to understand these mistakes because market crashes are remarkably cyclical. Seriously, whether we're talking about the Great Depression in 1929, the dot-com bubble in 2000, the 2008 financial crisis, or even the 2022 crypto collapse, we see the exact same pattern. The exact same mistakes are just repeated over and over again by entirely different generations of investors.
All right, let's jump right into mistake number 1, speculating versus investing.
Okay, let's dive into this. The first major trap is just a fundamental misunderstanding of what we're actually doing with our money. Most people out there sincerely think they're investing when in reality, they're just gambling. And this one confusion is responsible for millions of losses in literally every single market cycle. Graham defined a very strict contrast here. Real investing requires 3 specific things: thorough analysis of the business, safety of your principal so you don't permanently lose your cash, and an adequate return. Now, contrast that with your chaotic speculator, right? The guy who buys a random cryptocurrency just because it went up 400% on pure hype. There's no analysis, 0 safety, and completely unknown returns. Wall Street absolutely loves speculators, by the way, because all that frantic buying and selling generates massive fees for them. Now, if you're listening to this and thinking, but I really want to take a swing at something risky, Graham suggests keeping a separate, highly restricted account with absolutely no more than 10% of your overall portfolio. You've got to keep your financial future completely separate from your financial entertainment.
Moving on to mistake number 2, market emotions. So even if you clearly understand the difference between investing and speculating, you're still facing a massive hurdle. The fascinating truth is that the intelligent investor's greatest enemy isn't actually the stock market itself. It's our own psychological, emotional reaction to it. To brilliantly illustrate this, Graham created hands down the most useful character in all of finance, Mr. Market. I want you to imagine you just bought a 10% share of a really thriving, popular local bakery for $1,000. Every single day, your business partner, Mr. Market, knocks on your door offering to either buy your share or sell you his. One week, he is practically vibrating with manic excitement, offering you $1,400 because he's convinced bread is going to the moon. But then a few weeks later, he's deeply depressed. He's completely terrified of the economy, and he offers to sell you his share for just $600. The crazy part? The bakery itself hasn't changed one bit. Same ovens, same long lines out the door. Mr. Market is just completely, entirely irrational. The takeaway here is that you can never let Mr. Market's current mood determine the real value of your investment. Graham had this amazing saying. He said, in the short run, the market is a voting machine driven by popularity and emotion. But in the long run, it's a weighing machine driven by actual, real business value. Look back at the A&P grocery chain in the 1920s. By 1938, Mr. Market was so terrified of the economic climate that A&P's entire stock was trading for less than the cash they literally held in the bank. The intelligent investor buys when Mr. Market is irrationally terrified, sells when he's wildly optimistic, and the rest of the time, they just pour a cup of coffee and ignore him completely.
Which leads us directly into mistake number 3, following the crowd.
It is incredibly dangerous to just blindly follow the herd, especially when financial news is relentlessly positive, and it feels like everyone around you is getting rich. As humans, we're naturally wired to think popularity means quality. But as Graham noted, after studying a literal century of market history, popularity in the stock market guarantees a higher purchase price, and that mathematically guarantees you lower future returns. There's actually one specific crowd behavior Graham warned about really heavily: initial public offerings, or IPOs. See, when a company goes public, it carefully chooses its moment. And that moment is almost always when market enthusiasm is absolutely peaking, so they can extract the maximum price for a good story. Graham actually humorously broke down the acronym IPO to stand for Imaginary Profits Only, or even Insider's Private Opportunity. Just remember, the timing of an IPO always favors the seller, which means, by definition, it is unfavorable for you, the buyer.
Next up is mistake number 4, overpaying. Now, what's really interesting about this concept is this. Let's say you do everything right. You ignore the crowd, you do your homework, and you find a genuinely great, healthy company. Well, it can still be a terrible, wealth-destroying investment if you simply overpay for it. The price you pay is driven by a mix of math, like actual business profits, and emotion, meaning what people project the future will look like. If you overpay based on these highly optimistic, emotional projections, you're completely setting yourself up for failure. So how do we value a company without foolishly trying to predict an unpredictable future? Graham gives us 5 really practical ways to do this, all based on solid facts and protection rather than wild projection. First, you look at long-term prospects to see if the business is durable. Second, you check management quality. Do they admit their failures honestly? Third, you verify financial strength by ensuring they actually generate real cash. And finally, you look for a long, consistent dividend record and a healthy current dividend rate. Because as Graham famously said, there is no such thing as a good stock. There are only good prices.
All right, here is mistake number 5, ignoring diversification.
You know, this is the trap that catches some of the most careful, diligent investors out there. You analyze a company, it looks completely undervalued, so you confidently bet half your entire portfolio on it. This is so incredibly dangerous because investors often confuse their own strong conviction with a lack of need for error margins. And the shocking collapse of Penn Central brilliantly illustrates exactly why concentration is so fatal. Back in 1968, Penn Central was the largest railroad in the U.S. It was seen as an incredibly safe bet, trading at $86 a share. Yet by 1970, it filed for what was then the largest corporate bankruptcy in history, collapsing to just $5 a share. Careful investors who concentrated their portfolios here literally lost almost everything. The reality is, even correct analysis can have wrong outcomes because the future is just entirely unknown. And that is exactly why Graham strictly advised holding somewhere between 10 to 30 stocks across different sectors. Good diversification ensures that a single inevitable failure won't permanently destroy your wealth. And finally, mistake number 6, margin of safety. This right here brings us to what Graham called the master concept of all investing. It is the one foundational principle that makes absolutely everything else we've talked about click right into place. Why? Because it explicitly acknowledges the ultimate truth of the market. The future is genuinely uncertain, and you are sometimes going to be wrong. To actually utilize a margin of safety, you have to look in the mirror and ask yourself the single most crucial question an investor can ask. What if my analysis is wrong? Just asking that question entirely shifts your mindset. Instead of obsessing over maximizing your projected gains, you suddenly start focusing on minimizing the disastrous consequences of simply being incorrect. Graham explained this using a truly brilliant engineering analogy. Think about it like this. When engineers build a bridge that's expected to carry a 10,000-ton load, they don't design it to hold exactly 10,000 tons, right? No, they design it to hold 30,000 tons. That huge gap is there to account for hidden flaws, unexpected stress, and pure errors in calculation. Well, investing is exactly the same. If you analyze a stock and determine its true value is $100, and you buy it for $100, your analysis has to be completely flawless just for you to break even. But if you buy it for $65, that $35 gap is your structural safety net. It absorbs your inevitable analytical errors and protects your capital when reality turns out a bit worse than you expected. So how do we actually put all this into practice? Well, Graham lays out 2 distinct paths to wealth, basically forcing you to decide how you want to operate. First, there's the defensive investor. This path aims for satisfactory results achieved through really steady diversification, completely avoiding short-term noise, and having extreme patience. Honestly, it's accessible to almost anyone. Then there's the enterprising investor. Now, this is essentially a second job. It demands deep analysis, a truly contrarian mindset, and incredibly intense, disciplined work to go out and uncover deeply undervalued companies for superior results. The funny thing is, satisfactory results are a lot easier to get than you might think, but superior results are much harder than they appear. Benjamin Graham's principles have survived the Great Depression, the dot-com burst, the 2008 crash, and the crypto collapse for one very simple reason. Human psychology never changes. So the ultimate provocative question you have to leave with today is this. As you step into your own financial future, are you going to use these timeless lessons to take advantage of Mr. Market, or are you going to let him take advantage of you?